Yeah, pretty much. I mean, I'm trying to figure out how to move the slide, Jessica. There we go. So we'll go over a little bit about it. So there's different ways, there's different types of buy down. So the interest rate, like the rate you saw over there, let's say it's 6.999. That's the rate. That's what they're going to be at for 30 years. The way the buy down works is basically it's kind of like a prepaid account that the seller has to fund, and it's more or less a subsidy. So basically, they figure out, okay, the first year, if we do a 2-1 buy down, the rate's going to be 2% lower for the first year, and basically that seller is going to pay money into this account where the bank holds it and pulls the rest of the payment from. So basically, like if you're at 499, you can see the savings there is huge. Like, from going from a 2,770 payment on this particular example gets them down to 2,300. So that's 470 bucks. So you can see the annual savings off to the right, 5,640. And then you can see the second year goes up, 1% more, so 5.999, and the payments 2,530 versus the 2,770, saves them 240 a month, and then there's that 2,880. So the way the buy down works is that savings is what has to be funded by the seller. So in this case, if we're doing a 2-1 buy down, you're going to need that 10,162 from the seller. So basically, 3% concessions on that would do it. If you can't get enough concessions, even a 1-year buy down is a possibility. So instead of starting at the 499, it would start at the 599. It still helps. You only need the 2880. So that would kind of cover at least 1 year of better payments and other closing costs for them. Permanent buy down was what we call like a discount charge. So let's say we got the same amount of money basically from the seller, close to it. In this case, it was $9,000. It does help him. It gets him down to that 6.25 piece. But you can see here, the 1-year buy down is only 2,880 versus that 9,000. So if money's tight for closing costs, doing the temporary buy down is almost better, because then it covers a lot more. In this other situation, there's not much left to cover any other costs for your customer. So these are great ways to help people afford homes. And again, any loan somebody does right now, and this is what a good conversation to have with them is like, these rates are not going to stay this high. They will come down. I mean, we have a recession pending, and if they keep doing what they're doing with rates, it's going to be here sooner than later. And when that kicks in, that's when they have to flip gears from going to inflation control to recession control. And the only way they ever get out of recession, after seeing them do this multiple times, is they get the rates down. They start to help move the rates down. And all these people in these loans are going to refinance out into something better. Hopefully too, like the other thing that I think will happen is, as rates come down, the demand for houses goes up. So if values have dipped some because of the what rates are doing, when they come down, that's going to start that demand again. Not like we saw in the last couple of years. We're not going to see that. That's going to be a long time coming. But you are going to see a tick up in that demand. You'll see the values. You'll see less sellers wanting to give concessions and things like that. So buyers right now, if we can figure out a way to help them afford the payment, they're in a really great position, because again, there's not so many people out there shopping. They can actually get a house. They can negotiate the sales price. They can get help with closing costs. All those things that have been non-existent, especially having to pay over asking price to get a house. So these buyers are in a good position that way. It's just the rates that are making it hard, right? So the buy down program kind of bridges that gap. It's a really good way to help your customer afford the home. It gives them 1 to 2 years to get out of it. The best part about a 2-1 buy down, or a temporary buy down, we'll call it, is the money isn't wasted. Like if you do a permanent buy down where you get the lowest rate you can with the money from the seller, when they refinance, that money's gone. That's done. They'll never recoup that money they paid to keep the payment down. On the 2-1 buy down, that money's in an escrow account. So whatever they don't use, let's say a year in, rates have dropped and they can get a 499 in the open market. Well, there's going to be, after year 1, there's still going to be about $3,000 left in that account, that 2,880. So that money goes to their payoff. So it'll make their payoff on their home lower. So the money doesn't get wasted. So I like the 2-1 buy downs for that reason as well, because we just, I hate to see someone pay a ton of points and they're never going to recoup that cost. So these are good things to talk to your customer about, or with the loan officers you work with. Obviously we're happy to go over these things with customers as well. Let's go ahead. Anybody have any questions on that before we move on?
These are just similar to an ARM, only you have this money in an escrow account.
It's not really similar to an ARM other than it's really just subsidizing the payment. The rate's fixed. It's the 699, right? For 30
Right,
years. It just lowers that initial
right.
payment. So
I guess
you're not going to see the rates fluctuate like an ARM
fluctuate
rate. It can move around. You don't like
after.
there's caps on them and things, but you don't know where that's going to land exactly. They'll
But
have
most people do an ARM thinking we'll refinance in 3 years. So that's kind of, I guess I'm looking at it like that.
yeah, I mean they're both similar in that way. I think this is a little more something that other like people that don't want an ARM, this is a lot better because they still okay, I'm still getting a fixed rate. Like I know what I'm in for at the end of the day. It's not going to move around. I do have 2 years of a lower rate, right? So it's a little different and it's better for people that may be scared of ARMs. Most of the ARMs in the marketplace right now, unless you're in the jumbo market, like where the loan amounts are over the 647 with us, 715,000. Most of those rates for conventional ARMs, there's really no appetite for those either. It's hard to find a good one. Sometimes some of the local credit unions or banks lending their own money might have a good one, but in the jumbo space, the rates are still really good on some of the ARMs, but not when you're dealing with conventional or government loans like FHA, VA. It's really there's no big difference in rates. Sometimes they're worse. So
Got it.
this program here is probably your best bet for those government, FHA, VA, USDA, and your conventional borrowers. All right, let's do the next slide. All right, so this is another product that, a year ago was irrelevant, just like a 2-1 buy down. Like when was the last time you heard about buy downs or even ARMs? No one, no one's doing them. But now, different market, so different needs. The 6-month ARM program has been pretty popular. It's based on the SOFR index, and that index moves around like prime, which prime rate is the one the feds keep raising, and that's the one that all home equity line of credits are tied to. So anybody who has a home equity line of credit, like the other day they raised the prime rate 0.75, all those rates went up 0.75. So next time they get a statement, it's going to be that much higher, and then probably see that happen again in a month or two. So we're expecting another increase later this year. This program here, so and with HELOCs, it's every month. It can change if the feds change the prime rate. It'll change. It's just a monthly. They evaluate it every month. This program here, the rates fixed every 6 months. So the start rates on them start out really nice. They used to be in the 2s, 3s. Right now we're seeing 4s. Like we'll see 4.5 to 4.65 on this program for somebody buying a primary residence today. So this same person, instead of getting a 4.5, like in the open market, they're close to 7, right? So it's a big difference in rate. The only thing with this program is they are a little tighter on debt to income than the conventional loan, and you do have to do 10% down if it's a primary residence, 15% if it's a second home, and 20% if it's a rental property. The other nice thing about it is there's no mortgage insurance on it if you're at 10 or 15% down. So this one's been good with a lot of new builds, rental homes, multi-unit. Like the rates there's not a lot of big hits for being a multi-unit like a duplex or triplex, fourplex, whatever. So it's really good for those types of borrowers, and just people who know rates will get better at some point. The way that this one works is like if your rate starts at 4.75, the worst it can go up on month 7 is 2%. So that's the worst it could do. So if you're at 4.75, the worst it could be is 6.75, which is basically close to market rate today. The odds of it going up that much probably wouldn't do that. I checked one yesterday to see what the rate would be because it's basically a 30-day average of the SOFR index plus a margin of 2.75. So it was like I think it was 5.75 yesterday. So basically, if someone got 4.75, and it was already been 6 months, they go to 5.75, still well under market. And then the next adjustment, every 6-month adjustment after, it can move 1% up or down. And the other thing about these is when rates do go down, these rates will go down too. So it's kind of like a loan that one of the only loans you may not refinance when rates get better, unless, hey, I just want to go back to a fix. I know the rate's still higher to go fix, but it's, it's 4 again. I'd like to just lock in. That's great. We can do that. But at least, if they didn't want to, it's probably going to get down again. The lowest it could ever be is 2.75. So if rates, as the recession hits and rates come down, I don't think we'll see them get that low, but these people might end up being in 4s and 3s on it at some point. And, going to a fix, probably still be higher, but they want to do it anyways. Another nice thing about this program, they do offer non-QM loans. So non-QM is things like bank statement loans, debt service coverage ratio loans. They do offer it. The rates are higher, but they don't do prepayment penalties on them, which most of the lenders that do those types of loans do if it's not a primary residence. And the rates are much better than most of those types of lenders. So definitely a good program. Not many brokers have it, but we've been able to use this product for a lot of people. So it's a pretty good program. So if you have something that's not quite fill in rates and would want to explore something like this could be a great option for affordability and just to kind of ride out the market we're in for a time being. Any questions on that?
Next slide.
Yeah, let's do the next slide. So yeah, this year the conforming loan amounts are 647,200. A lot of the banks we work with, they're letting us do 715 now. So that's just an anticipation for the higher conventional limits next year. Conventional loan limits next year will probably be higher than this. I would assume 720 something to 730. But they don't know for sure where it'll land. So for now they're doing the 715, which is huge because this keeps borrowers out of jumbo. If you have a borrower that's buying something, in these higher price points, trying to find a good 5% down jumbo program or a 10% down, I mean, it's like you're going to see high sevens, eights, like it's not pretty. So this is really helpful for those people. Basically, if you're doing, like you can see off to the side, 20% down. I mean, that means they could buy almost an $895,000 home almost, and with 20% down. And it's really helpful in these like the 5% or 3% down, like 752 with 5% down, 731 with 3% down. That's a lot more buying power for people to get into homes. So if your lender isn't offering this is something to talk to us about if you have so many of these price points. I also think for realtors, it's really important to know what the loan limits are for your FHA loans, your conventional loans, things like that, because sometimes you might be listing a home just a little bit outside of where someone has access to a lot more financing options. Like getting a home. There was one the other day I was talking to an agent and the home was listed at 8 something, and I'm like, well, 5% down or 10% down, you should be here now because we can go up to 715. And they were just kind of priced out of that. So the very motivated seller, so they lowered the list price to 795 to try to have access to more homeowners. So, if you're ever, when you list the home, if it's not selling, you may want to check what the loan limits are. Like VA, if they don't have another VA loan, sky's the limit pretty much. I mean, they go up 2-3 million now. But for your FHA loans, it's 441,600. So I think it's like a 457 price point for 3.5% down. So if you're like at 460, 461, home isn't selling, maybe lowering it to 457 will get you some more borrowers that are looking for an FHA loan. But yeah, that's good info to have. Okay, let's do the next slide. Yeah, so we're a mortgage broker and versus a mortgage banker. It's good to have probably both in your pocket. Sometimes there's some down payment assistance programs or things a mortgage banker might have that we don't have, and vice versa. For us, we can go a lot lower on FICO scores. We don't have all the overlays. We're going to have a lot more options and kind of out of the box things for people. Plus, just in general, our rates will be lower because we're dealing with wholesale lending and we're shopping. We have, our company, we have like 40 to 50 different investors we shop with for our customers. So instead of somebody having to call 3-4 places, we're going to put in a loan scenario. We're going to price out 40 to 50 banks to see who's going to give our customers the best terms. Also means like we don't have processing fees, application fees, doc prep fees, underwriting fees. So just out the door, we're usually going to be anywhere from $1,500 to $2,000 cheaper, and the rate should be better, especially on government loans. That's where most of the banks make their money, is they have higher margins on the government loans, like your FHA, VA loans. So a lot of times their rates on those are very similar to conventional, whereas ours are going to be a good 1%, sometimes 1.5% lower than your mortgage banks. And some places use the term broker, but they're not truly brokers. They basically get their rate sheet every day, have margins built in to cover different things and stuff like that for the overhead, the upper levels of management, yada yada yada. So there's a lot more built into what they have to make on a loan versus how we operate things as brokers. Let's go to the next slide. Yeah, so this is just kind of more the stuff here so you can see. we'll just share the slide, but you can see basically how kind of some of the differences between a mortgage broker and a mortgage banker. And again, they're both good to have contacts for both. You don't want to just have brokers. You don't want to just have bankers. But yeah, if anybody has any questions on that, you can definitely let us know. Let's do the next slide. Yeah, I mean, this is a big thing too. 47% of homeowners don't even compare lenders. So this is a kind of an outdated thing, but again, with us, we're already going to be comparing lenders for them. We're going to be shopping 40 to 50. So even if they don't call anybody else, we've already done some shopping for them in their behalf. Let's go ahead. Yeah, but I think that's about it for today. We'll do some more interesting things to talk about next time, but I do think anybody trying to sell houses right now, I mean, this is going to be a time of concessions, of high closing costs to get people into rates and to the payments they can afford. So a big thing to do is just come in offering concessions so these buyers can do a 2-1 buy down, so your sellers can sell. It's a necessity at this point, to have that into your listings, in my opinion. Otherwise, we're going to see, to go over. So I was going to do this too. How do I share my screen here?
Here, I'll do this. I will give you. Okay, go ahead. Should be.
All right, let me see if I can do that. Let me see, share screen. All right, here we go. All right, so I just wanted to show this. So let's say you have a $600,000 listing. Is it not on that? Can you guys see my screen?
I can see your point.
Whatever. Yeah, that's what I'm showing. Yeah. So this is just let me change that. So this is a $600,000 home. Let's say with taxes at 225 or something. So this is just a 5% down conventional loan, 6.999, 4,220. So basically, if you want to sell a home for 600, this is what that payment looks like for somebody, which is pretty crazy. If you offered them a buy down program, and we can start them out at 4.999, that's 3,488 a month. So that's a lot better for the borrower, for the buyer. And if you had to do a 3% concession to get there, that's not too big of a haircut, off of the price. You leave the price at 600, you give them the 3%, call it a day. Basically, that does a lot more for someone than doing a price reduction. Like let's say you lowered the price 18,000. What is that? 682 or 582? 582. It went down about $100. So that's not going to change anyone's life, doesn't really help with the payment. It's a little better, nothing crazy. So it's much better to go in at 600, get the concessions, and do the buy down. That'll help the home sell a lot better and keep the values at a better place versus coming down off the price all the time. So I think those are good things to remember. Just before you offer a price reduction, just offer concessions, and that'll give people more bang for the buck. But yeah, I think that's all I have for today.
Does anybody have any questions? I mean, that was really good info, Andy. I appreciate that.
Yeah, for sure.
That was really good. Yeah. I will get everybody a copy of the slide and a copy of the recording so you can look it over again, just so they have it.
Yeah, that'd be great.
I think it was really good info. Yeah.
Yeah, well, I appreciate everybody who joined today. And, if you have any questions, just reach out and we'll be happy to see what we can do to help.
Okay, thank you so much.
Hey, thank you for joining us.
Thank you.